It's got to be a blend. So like you don't want to have 100% occupancy because that means you're not pushing rents high enough. I think the magic number on occupancy is what, like 96 or something percent. So that it's like you're not just giving away the farm on rent so that you can be occupied. You're actually like pushing the rents higher. So it's a combination. It's not just one.
The Real Estate Hustlers podcast. I'm your host, Josh Appelman, founder and CEO of Appelman Properties. Today we are joined with Elijah Brown. Elijah is a USC business grad, transitioned from a REIT, that's Real Estate Investment Trust. It's a publicly traded company for those tuning in. Analyst to co-founding GoldHawk Capital, amassing over $300 million in multifamily assets and serving as a U.S. Army Reserve officer. Elijah, we're excited to have you on the show today. If you could, let the listeners know a little bit more about yourself.
Yeah, thanks so much, Josh. I appreciate it. And hello to everybody listening. Thanks for tuning in. I'm really excited today to jump on with Josh and share a little bit about my story and hopefully inspire some of you to go out there and build a real estate portfolio. It all started for me back while I was still in college. I was able to convince my best friend and my cousin to go in with me on a single family property all the way across the country. And somehow we came up with the $40,000 that we needed and got the bank to lend us money. And we put a tenant in that unit. And then that was the start of all of it. Fast forward 7 years later, we've got a portfolio of 2,000 units. So
that's incredible.
Been some really awesome growth. Yeah.
That's definitely inspiring, the story and the run up that you've had. So starting essentially literally from ground zero and then amassing a major portfolio. Can you give the journey away? Tell us how you go from one step to the other, because you're biting off chunks as you go, and as far as knowledge, internal knowledge and learning.
Yeah, sure. So we started with that first unit, and at that point, I had watched a ton of YouTube videos and had decided I'm just going to build a portfolio of 30, 40 single family properties. And so we started doing that. We did one, then we did another one, then we did two more. Each time bringing in a few more partners, pretty much just close friends of mine, to help finance the deal. I ended up getting a job right out of school at a real estate investment trust called REITs. And I was just an analyst there. But on nights and weekends, I was hunting for my own deals. And I was able to partner up with a bunch of my coworkers at the company. And together we took down a few smaller multifamily buildings. The jump from single family to multifamily came about because the guy who actually hired me to work at the REIT recommended it. He pulled me aside. He's like, Elijah, if you actually want to get rich here, you're going to have to buy hundreds of these single family units and then hope that it goes well, whereas you could just buy some multifamily properties. You probably spend less time, it'll be less work, and you'll be able to force your net worth growth much faster. And so we did that. We jumped in, started off with a 6-plex in Florida, and then I got a 5-plex in Tucson, Arizona. And then, from there, we just started buying more and more and decided to focus on Arizona.
That's awesome. So you knew, and working in a trust, you had access, I'm sure, to data, methodologies, and certain things that how they analyze markets, properties.
Not at all.
Not at all. Okay.
Not at all. So this company is focused on healthcare real estate. It was mostly, senior housing and medical office. Those were the two departments that I supported. And now, what I did learn there was cash flow modeling, analysis, preparing presentations for investment committees, being professional and speaking professionally. It really had nothing to do with multifamily or any of the components to getting a multifamily deal done. So I really had to learn that on my own, doing my own deals. But what I picked up from the corporate world was essentially how to be a professional and how to underwrite cash flows.
Awesome competitive advantage, though. Some of the technology that these places have, institutional companies have, is it's incredible. So what you started with investors, started with colleagues. What what made you want to expand out and get more investors, and then eventually, I mean, you're syndicating. You tell us a little bit about that journey and how you overcame
So
challenges.
it all started with the friends and family. I did that for about 6 years, where I didn't have any kind of like email newsletter or lead generation. I wasn't even doing LinkedIn for the first 6 years. I was really just like going out, finding deals, and then sending an email to maybe 5 or 10 people that I know who might be interested in the deal. And so I was able to get, all of my deals funded through just that small network of people that I knew. And then at the beginning of this year, actually at the end of 2022, when things started getting a little hairy and investors started sitting on the sidelines and not wanting to get into deals, I realized that if I wanted to grow my portfolio and continue raising capital, I had to source it from somewhere else. I needed to go to the retail market and to high net worth investors, and I figured LinkedIn was the best place for that. And so it wasn't really until this year, like January of 2023, where I started like actively pursuing people who were not friends, family, or coworkers.
Nice. And is that so? Is that proving to be the place to go? Do you feel, or I mean,
Oh
friends
yeah,
and families? There's okay.
it's great. So with the friends and family list, I had about 75 contacts on that list, and I could probably convince anywhere from like 10 to 15 of them to invest in all my deals. So the conversion rate was extremely high on that, and that makes sense because those are the people who trust me and like me the most. Like they're in my inner circle. When you branch out into retail and high net worth and essentially strangers, people you don't really have a strong relationship with, the conversion rate goes way down. So instead of converting, 10 to 20% of my network, it goes to converting like 1 to 5%. And so I knew this. And so the whole goal became to generate as many like new investor leads, potential investors as possible, knowing that, in the worst case scenario, only 1% of them would invest in my deals. And so I've just been trying to grow that list and grow my networks and make relationships with people so that I could continue to fund these deals.
So is this something that you preemptively thought of? Of course, you got to raise capital in order to expand and scale in real estate. Is this something you seek mentorship on, or is it something you just sort of gravitated to and navigated to?
It was like the next logical step in the progression of finding capital. So always start with, friends and family, because they're the only ones who are going to trust you when you don't have a track record or experience. And so you need to go, fill your deals up with friends and family capital first, and actually your own capital if you have it. And then once there's no more of that, you need to find money from elsewhere. And the next logical step is to go to high net worth people on social media, or, because word of mouth will only go so far. Like your small group of contacts will only introduce you to so many. And so you really need to go out on social media or go to in-person meetup groups and events. In my case, I was a traveling digital nomad, and so I didn't have really the opportunity to go to, meetup groups. So I went to social media and I made relationships with retail high net worth individuals.
Got it. For those that are uh, just coming in and enjoying the show, if they wanted to get into real estate, they don't have experience, they can build relationships. Um, they feel like they can to at least join. How would they structure the deal? They can even find the deal. How would they structure the deal with the investors?
Yeah, so there's a lot of different ways to do it. I think like the easiest way, if you can make the deal work with like 5 partners, then just make it what we call a joint venture or a JV. And with these deals, you're not selling securities because everybody in the JV, all the partners have a material responsibility, or they're actively participating in the actual management of the deal. So you give everybody a job to do in the operating agreement, and then you don't have to essentially file documents with the SEC and provide a private placement memorandum and do all this crap to essentially sell securities to people. As soon as one of those people becomes passive, as in they have an expectation of a return and they invest money with you and they're not doing anything, they're just getting their checks, you're selling securities. And it doesn't matter how many people are involved in the deal at that point. If someone is a passive investor, then you have sold securities to them, and you have to do all this work to essentially tell the SEC that you are exempt from filing more documents with the SEC. And it's a whole process, and there are a whole bunch of different exemptions that you can qualify for to get these deals done. The one that we use most is called a 506B. It's essentially us telling the SEC that, hey, we're not going to advertise our opportunity, but we're still going to be exempt from all your rules, and we're going to file all this stuff because we're a very small offering and we don't have a ton of investors involved, and we're going to file a Form D and check all the boxes and follow all the rules and only work with sophisticated investors that we have a pre-existing substantive relationship with. And essentially there's a lot of things you got to do it legally.
Yeah. And on a joint venture, you can have weekly meetings and everyone puts in their opinions, just updates on where the properties are at. Just if everyone inputs different sides, and then they're actively involved, and it works out, and you're clear. That's when you're bringing joint venture together, does everyone split a pro rata share of the property, or is it say if Elijah brings the deal, operates the deal, has the larger piece of the success of the deal, would it still be split pro rata equally, or I guess
it depends. I think you can customize it as much as you want, obviously with the advice of an attorney who does this for a living. I have done JV deals where it's like obvious that I'm doing the majority of the work and everybody else is actively participating in a lesser way, and so I'm going to take more of the profits because of that, or I'm going to get some other type of benefit for that. So there's absolutely room for you as the deal organizer to make additional money. So.
Yeah. And I think that when you're sacrificing time for the performance versus sacrificing money for the performance, there's one that you can never get back, which should equal a greater share of the pie. And ultimately, if your track record proves out, then everyone kind of knows where the deal should go if everything goes like it should. So
I will
there's a
mention,
balance.
Josh, in the beginning, I didn't take any kind of fees or split or acquisition fees, literally nothing. I was just interested in getting into deals. And so I only had like $5,000 or $10,000 to start with.
Yeah.
And so to get into these deals, you need $50,000, $100,000, $150,000 in these tiny little deals. And so I had to bring in partners, and I saw my fees that I was earning as just being the opportunity, the privilege to participate. And so I didn't charge fees for like my first 4 deals.
Yeah, and that's honorable, and that in my opinion is the right way to do it, because you are those first people that come in, they're believing in you. They believe that you can do what you say you can do, and now you get to prove it to them. And as you build that track record up and prove it out, now your time becomes justified. I know that it's a balance. Every deal has a balance, and then the fees that you do get essentially offset the cost that it takes to get the deal underwritten and everything else to stay as a real estate operating company. Because ultimately, as you scale, your overhead grows with you, and the fees help offset hard costs. It's just, what about the operation side of your all's business? Are you all actively operating the properties, or are you third party?
This year, we made a massive switch in our mindset and our business strategy. So for the first 6 years, we were actively syndicating our own deals. We were doing all the work of going out, finding properties, finding investors, lenders, contractors, property managers, doing literally everything. And it was brutal. We were able to take 12 of our deals full cycle. We hit 70% average IRRs, and we made a decision that we essentially never want to do that again, because it was for us a horrible experience, super stressful, and we got the job done, but it wasn't without a toll on our physical and mental health. And so we became, at that point, passive investors. We became expert passive investors, and we at the same time realized that we could write $50,000, $100,000 checks as limited partners for these much larger deals. But at that point, we're just another name. We're not getting any kind of leverage or a seat at the table or literally anything for that. We're just getting our 70-30 and then a 50-50 profit split for that, which was really unacceptable to me, having been on the other side as the general partner. So what we decided to do is we started what is called a fund of funds, or you call it a syndicate of syndication or syndication of syndication, where essentially we would invite other limited partners, other passive investors to invest alongside us within our LLC. And so we syndicated our own pool of capital and then used that $1 million to write one limited partner check over to Joe Schmo's deal. And then we went to Joe Schmo and we said, here's a large check, but I want a better deal. I want a 90-10 profit split or an 80-20 or whatever. And that's how we were able to then create a better situation for ourselves because we were investing a lot more money at that point.
That's interesting you brought that up. I was on a webinar over the weekend, and it was there was a platform that was brought up, and it's called TribeVest. I don't know if you've heard of that.
I've heard of it, yeah.
And it's an incredible model where essentially you bring in people that you've been successful with and that trust you, and you can vet deals, and then everyone just puts their seat into a much larger deal. I love the concept, and I think fund of funds is definitely the future versus, say, a co-GP on certain levels. I think you can get into just massive properties that otherwise would be almost very difficult to get in without an institution.
For our buy box, the deals that we're looking at, we'd have to bring $10 million per deal to be able to participate in the GP. Now we're only writing, $1 million, maybe at most $2 million checks for each deal here, and so we're not investing nearly enough to get GP. We're just a limited partner in these deals. Eventually, once our business grows, maybe that's this year, we'll be at that level where we can write $10 million checks and actually have a seat at the table. But that's not where we're at now. And actually, I would think that if we get to that point, maybe instead of writing $10 million checks, we're just going to write 10 $1 million checks and diversify into different kinds of deals. So that's something to think about as well.
Yeah, it's great that that's out there, and you don't have the blue sky filings and everything else that you go through for the regulatory for the SEC. So
we do. It's all the same. It's exactly the same as a regular syndication. So we have to do all the Form D, the blue sky filings. We have to provide our investors with private placement memorandums, subscription agreements, operating, the whole thing. We have to do it all. It's just, we're buying equity in a company. We're not actually buying the real estate. So it's a little different.
And I apologize. I was thinking of TribeVest. They handle the
right. But they're still doing all that. They're still doing all of that stuff. In my example, like TribeVest or not, I'm still having an attorney do all that work. I'm not doing it. So it's but yeah, TribeVest is great. I think we're going to actually use them on a deal coming up really soon.
Yeah, no, I love the concept. It's eye-opening that that's out there, it's available, and if it expands our horizons, then it's what it's there for.
Yeah.
Let's talk about the market. We've got it's doing what I think the Fed wants it to do, and now things are finally starting to catch up. What is your outlook on 2024 with the capital markets and just in general?
I think at least the first 6 months are going to be very rough. I think we're going to see a continuous decline in property values, increase in loan defaults. That's essentially going to drive people to fire sell their assets because they don't want to give them to the bank, or the bank forecloses, and then 9 months later they're auctioning off properties. And so I think we're going to see a lot more distress coming up, which is by far the best opportunity any of us have ever seen in the last 15 years probably. And so right now, we're focused on averaging down our position and essentially buying in over the next 6 to 12 months to be really well prepared with a solid basis for a 2026 exit. That's what we're looking at right now.
I've heard survive until 25 and then survive until 2027. So I'd say 2026 definitely starts bouncing back.
We don't know. Nobody knows.
Yeah, who knows? It's anyone's guess at this point, but there's a lot of a lot of these they just repriced the market for next year. So instead of and this was just this morning, I was listening to it. They're saying the Fed might have to lower rates by 275 basis points come middle to the end of next year, because it's finally what they have just dramatically done is going to be catching up, and it's going to be a
What I don't understand, Josh, is that like Jerome Powell and his team, they have to understand that like the impact to real estate after a change in interest rates, it could take 9 months to a year. And so like, of course, like all the shit's going to hit the fan, like, starting now. Like, did they not realize that when they continued to lower rates the last 3 times? It's like, I think they went a little bit too far. And I think a lot of real estate investors would agree that they went a little too far, and we're going to start seeing the real impacts of this over the next 6 months. And I think it's going to be dangerous. So,
well, it's almost like a pump and dump, because they deployed so much capital in the market at one time, and it's all almost like preemptive, because of course you deploy that much capital and now you're burning it this rapidly. Things are kind of it's like they do know. It's election year. It's going to be turbulent as hell.
yeah, no, absolutely. It just feels like they're trying to like force a recession. And so I don't know. For us as like fund of fund managers with a longer term perspective, it's like, sure, like bring on the blood. Like we'll keep buying as the prices go down. That's great for us. But it really sucks for anyone who has a position that started in 2021 or even last year.
Yeah. Did you
including us? We have a few of those too. So.
That's what I was going to ask. Did you all get caught with any floating rate?
No, luckily. I've got 3 properties left in my active portfolio that I haven't sold, and so we're going through refinances on those right now. Obviously, it's like great. We picked the absolute worst time to get a refinance done, but we'll be okay. We'll sit on those and cash flow them for as long as we need to. But luckily, most of our passive positions are doing all right. I think there's one where the DSCR is in questionable territory, but I'm confident that the sponsor will get us through it without a capital call. So, but I know almost every limited partner that I know is experiencing pauses in distributions, and I'd say half of them are getting capital calls. So it's a really scary environment right now for limited partners who got in over the last 2-3 years.
I don't know if the feature has been there, but I've got the Invest Next portal. It's what we use, and now there's a capital call button at the top. I never noticed it there before, and then all the screens pop up of how to utilize it. So I don't know if it's a new feature, if it's just been something that I've glazed over, but it's happening. I mean, if you can weather the storm, keep the asset, and then fare another day, then it works out. Yeah. I think if it's a sinking ship, pre-plan, and it's. That's real estate though. There's true risks, and that's with anything you do, real estate or stock market, anything. There are risks involved.
For any of the sponsors out there, like understand that like capital call is a far better option than ever giving keys back to the bank or fire selling, just because like you don't want to lose your investors' money. Like it's more worth it to plan for a longer term exit, especially if you can bring in what's called preferred equity. So a lot of sponsors are doing this because the lenders are, believe it or not, the lenders have not left the market. They're all still there. It's just nobody's qualifying for loans anymore because the rates went so high. So their DSCR is in the toilet. And what you can do, however, is what's called a cash-in refinance. Essentially, you can refi at a much lower amount of leverage and fill the gap with cash. And so what sponsors are doing now is they're inviting preferred equity investors to come in. Preferred equity sits higher up in the capital stack in terms of order of payback. So you have like the regular equity investors at the very bottom, and they get paid back last because they're taking the most risks. They get the upside, but they get paid back last. You got the senior lender all the way at the top. They get paid back absolutely like number one first before anyone else. And then in the middle, you can have preferred equity, which usually entitles investors to a certain percentage rate of return with no upside, and they get paid back next. And so it's like a medium risk, medium reward situation. And so you do that, you don't end up really diluting all the common equity because there's no upside for those investors. They're just getting their 12% or so rate of return, and they're not getting a slice of the profit pie at the end of the deal. So that's for any of the sponsors listening, try to raise some preferred equity to do a cash in refinance.
Yeah, that's huge. I'm glad you brought that up. I mean, ultimately, you can re-underwrite the deal in today's environment, and if it still looks good, makes sense. Absolutely, anything besides giving it back. There have been instances where you do a capital call, and then ultimately it still goes opposite direction. So it's just doing right by all that's involved, and knowing when the limits are too. And that's where changing tides experience comes into where we're heading into, and that's experience through being a business owner, entrepreneur, knowing how to crush those unneeded expenses on a property and ultimately pivot. What are some other outline ways that we can make this thing profitable, make it work? What are some of the things that you all look for when you're underwriting properties?
Yeah, so when we have like a 69 question due diligence checklist for because we're now expert passive investors. We're no longer doing the initial underwriting. The sponsor sends us that when they want us to write a check. So we have our own completely comprehensive due diligence checklist. You guys can download it at goldhawk.us/inspection if you want. And essentially what this is it goes through all the questions that we ask as passive investors and want to know about, before we invest in a deal. And so it really starts with trust in the sponsor because from my perspective, the underwriting doesn't mean crap. It's literally just like a crystal ball shot in the dark. Like who actually knows how it's going to perform, especially like IRR and equity multiple. It's like how do you know what the exit cap rate, how much the property is going to sell for at the end is going to be? Like you really don't. You're just guessing. And so like those metrics really don't mean much. They it's kind of just like for weeding out deals for us. What's really important is the yield. So the yield on cost that the deal is producing, the DSCR. So like, is the property generating enough income to like pay the mortgage every month? Like that's really important because I really care about right now, like in sponsors who are not going to lose my money. Like, great, make money, great. Doesn't who knows how much you're going to make, but just don't lose my money. So that's really what I'm focused on. I think the number one thing that I really care about is right now track record. So if a sponsor is new and they don't have any full cycle deals, I'm not going to invest. I'm sorry. And I know everybody hates to hear that because there could be an incredible opportunity with a really talented, sponsor who just hasn't taken any deals full cycle. And having been there and having been the guy who was actively doing deals, I understand how important the learning process is of doing a full cycle deal. And so if you haven't had a few of those already, then it's like, beware. It's like maybe you should just raise money from your friends and family first and not go to, investors. So I really care about track record. I try to look for sponsors who have at least 5 full cycle deals where they crush their projections. And then, I'll have multiple conversations with the sponsor and try to understand their thought process and how they work and essentially build some trust there. The underwriting has to be conservative, no more projecting 5% annual rent growth and
Yeah.
30% operating expense ratio. It's like, no, like I want to see like 0% in year one on rent growth and then 3% like after that. And I want to see like a 50% OPEX ratio, even though it's crazy. In a lot of markets,
I totally agree.
You won't even get there.
Yeah.
Like it's just like from an investor perspective, you just want to see how conservative can they make those projections and still come out hitting our target, returns. And so those are kind of the things I look for when I'm looking at a deal.
At what point does the deal break? I mean, that's the biggest. On a call last week, a podcast with Neil Bawa, I told him I'm doing 0% rent growth for the next 3 years. I said I feel like we're at a plateau, might decline, and then we might see some growth in 3 years. And if that's not the case, great. I'm still underwriting to be conservative.
Yeah.
And if I don't, if we don't get the deal, we don't get the deal. It's just those are the kind of things that you see out there. The 5% rent growth, 3%. I'm not. I feel like that we've seen the height, and we're we might need a reset. But I'm glad you said that.
What do you think about debt, like in underwriting, like all these bridge loans and interest rate caps? What's your perspective on that?
Definitely the cap. I mean, we've got extensions on a few loans, which we're positioned to either refinance or have an extension put out. It's kind of a catch-22 because, like you had said, it's a horrible time to. It's not a horrible time. It's the times, right? So it's just there's always going to be a storm on the horizon. If it's not interest rates, then it's something else. Um, Granted, the unforeseen is what we don't know, but do we get an extension, see where rates go? Do we go ahead and refinance and get this thing into a 10-year term? I don't know. The properties that and we self manage too, so we're a different scenario. We push as hard as we
Sure.
can, but we're safe. I mean, no matter what it is, the properties are doing great, and we've got options. There's some people out there that just don't have options.
What about for like new underwriting, new deals?
I mean, as far as interest rate goes,
Like, what do you want to see for like debt terms on these new deals?
yeah, you're going to have prepayment penalty if you, of course, with a lot that you're going out there. But if you're going for agency debt, are you what's your time horizon? What does your disposition timeline look like? What's your business plan? If it's a bridge loan and it needs a lot of capex, it needs renovation dollars put in. Are you going to raise that money? Or are you going to get it from the bank? I want to ask you that.
Sure.
Would you rather see the sponsor raise the capex, or do you want to see that in the debt?
It really depends. I want to know that like the DSCR in year one is going to be like over like a 1.3 at least.
Sure. Yeah, for
So
sure.
it really just depends. If the deal has positive leverage, which essentially means that they're going in with a higher cap rate than the interest rate on the loan, then I'm comfortable with them taking like more leverage, like up to 80% loan
Yeah.
to cost on that. And so it really just depends on the deal. Like, can the cash flow actually support the payments? If it can, with a large degree of margin, like with a large safety margin, then sure, take on some debt. But if it can't, then I'd say like really go in with less leverage there because it's a riskier deal.
And meat on the bone as far as where our market rate rents, and we're comparing market rate rents to what are the FMRs that HUD actually pumps out. That's the baseline that we're actually going off of, because ultimately the government subsidy programs, they put in their analysis, and what they're saying FMR is fair market value. That's what we're our performance, not the place down the road. So we
Yeah.
feel like that's not conservative. It's safe. It's if we get more, great. It's kind of hard to get less, because I think that we'll just plug in a program and cruise through.
Yeah, it's a good point. And so like the way we approach like rents and stuff on our active portfolios, we have our property manager just look in 5 mile radius. Just like what are the actual rents in like a 5 mile radius, like in this actual neighborhood pocket of this city, like not national data, not like full MSA data, like literally just in this one neighborhood, because it's so different neighborhood by neighborhood. That's like what we do for, obviously, for the deals that we're passive investors in. We don't want to be that down in the weeds. We want to trust the sponsor to be able to do that. And so we'll ask a lot of questions about their process for doing that in the beginning to get comfortable with it and figure it out. And obviously, if they're like vertically integrated and they own the property manager, that's so much better. But we just want to understand their process, not necessarily micromanage it. And so it's just a completely different approach for us.
Like, property management is important, especially if you're not in business to be a property manager. You're in business to make sure the property performs.
Right.
There's a massive difference, because that other property management, that site has its own set of bills, versus just
Yeah.
one set of performing bills. There's a platform that I've been on the phone with the founders. It's called HelloData.ai, and they comp the rents. They've got an algorithm to where they can go down the streets and comp the rents based off pictures. I mean, it's
That's cool.
incredible what they're doing. It's their level of data sets and what they're pulling and aggregating. It's amazing.
Very cool. I
Um,
think like the best way to go about it, well, within multifamily, is like look at like all the similar buildings in like a 10 mile radius, and then like figure out what the average of all the renovated units are there, and then like come in lower than that average
yeah,
so that you can penetrate the market, and fill your building. So I think like regardless of what the AI or anything says, it's like literally just go shop the comps. Like
yeah.
it's all there on apartments.com.
Would you rather see high occupancy ratings or high rent growth?
High. It's got to be a blend. So like you don't want to have 100% occupancy because that means you're not pushing rents high enough. I think the magic number on occupancy is what, like 96 or something percent. So that it's like you're not just giving away the farm on rent so that you can be occupied. You're actually like pushing the rents higher. So it's a combination. It's not just one or the other.
Yeah, I think that there's areas in Texas where it's normal for a 15% vacancy because their rent premiums are so high and they've got
Sure.
so much competition. There's so much being built versus
Yeah.
say Midwest, it's high occupancy, it's sub
I think
two.
9 times out of 10, if you choose the rent over occupancy, you're going to lose more money, or you're going to be worse off. Like I, as like more of like the risk averse conservative type investor, would rather have like a full building than losing money to vacancy cost every
Yeah,
month. So that's just me. That's kind of a personal thing though. But
I
I think
totally,
the
that's the same with
I think
me.
so. In that building that you're explaining, I think the right move there would be for them to maybe ease off a little bit on the rent increases so that they can get their occupancy over 90%, and then at that point, then they can kind of start increasing rent.
Yep. No, and there's a balance, a true balance to everything. It's just there's some areas that where it's just a norm. It's like an expectation. I can't understand it, but
On a
uh,
lot of these properties, their break even occupancy, like on most multifamily value add deals, it's around 75%. And like we look for like break even occupancy lower than 70%. Like I want it to be closer to 60% or
yeah,
less, even, which is almost impossible to find. But it's so if you have like an operator like purposely keeping occupancy at like 85% or even 80% just so they can push rents, it's like they're getting close there to like a point where, let's say something in the economy happens and rents go down, it's like they have a less occupied building and rents are going down on renewals, so they're kind of screwed. They're getting
and
close
they,
to that break even. Yeah.
and they bought it on a sub four cap with
Yeah.
a
Also,
huge.
like when you got to sell the building, and then a lot of agency lenders have these rules about being like 90%
Oh
occupied
yeah,
for 90 days. And so it's like if you want to sell the building, you need 3 months of like full occupancy to
yeah,
be able to really get like let someone take on a new loan on that.
I totally agree. What are give us one of your biggest learning lessons in your career so far?
Focusing. And this is a page straight out of like Alex Hormozy 101.
Yeah,
Essentially, most people are like so distracted by the new thing, and anytime it gets difficult or hard, they find themselves in the valley of despair, they just quit. And anytime there's like something new and sexy, they chase it, and
yeah,
they're like, oh, quick money, like I can make 50 grand real quick if I just go and do this deal really, really fast. And they don't ever end up becoming like the really in-depth expert in their one little niche. So my approach here is like, let's just focus on like the one or two things that we're like really good at, build this business and do the really boring repetitive things every single day needed to like grow this business. I'm going to put like all of my water in this one cup until it overflows and then start diversifying. So, and I made that mistake for like the first 6 7 years of this journey, where I was like going all over the country to invest in deals. I was investing in different types of assets like single family and multifamily and different sizes and different strategies. And it wasn't really until like 12 months ago where I decided like, okay, all we're going to do is like Phoenix and Dallas 100+ unit multifamily buildings, only value add strategies. And that's literally it. And that's all we're going to do. And we're only going to focus on LinkedIn inbound marketing to get leads. And that's all we're going to do. We're not going to get on TikTok. We're not going to get on Instagram. We're not going to do Facebook. We're not going to do paid ads. We're not going to hire employees. We're just going to post 3 or 4 days a week on LinkedIn and then interact with those posts and do it consistently every single week until we build traction and it's actually working. And that's what works. So,
yeah. That's going a mile deep instead of a mile wide for sure. Um, our morning meetings here, the staff, the question I had them answer last week was if today is November, call it 17th, 2024, where are you at? Where are you at currently, and what have you achieved? So this week is you're going to pick one destination. A ship doesn't leave the harbor without a destination. And now we're going to compound on how we're going to get there over the quarters, and then daily and weekly. So it's
such a
focusing
good
on one thing.
approach. Work backwards from that. That's exactly what my partner and I do for our goal setting. We're like, okay, how do we bring it in? Like, how are we going to bring in an extra $5 million in capital this year from our LPs? And we worked backwards, and it was like 15 steps to get down to our actual goal, which is just bringing in like 250 new leads per month into our system, because based on conversion rates, that gets us to our goal. And even deeper than that, what does that mean? Okay, that means I have to post on LinkedIn 3 or 4 times a week. We need to bring on a virtual assistant to follow up on the comments and stuff like that. So like we have all these actionable, boring things, and it shows up recurring in my Asana every single day. And I look at it and I go like, oh my goodness, like I got to do this for the next 5 years. And it's like, yes, you do. We have opportunities to sell all kinds of crap and do one-on-one coaching for $500 an hour, but I'm not doing that. I'm like playing the long game here, taking like 2% of the money that I raise as an acquisition fee and living off that, so that I can get the $100 million payout in 10 years from now. That's the whole point.
Yeah, we use Asana over here too. It's it helps structuring exactly where you're going and subtask it out, and then checking those boxes and getting unicorns. So it's just working the deal, working the plan every single day, taking action.
Right.
Started doing the miracle morning too, so it's incredible what just the change and shift in your routine and what you can achieve in different morning hours. But
you gotta do the boring stuff.
You have to, man. Absolutely. But Elijah, if somebody wants to get a hold of you, find out more about GoldHawk Capital, how can they reach out?
Yeah, LinkedIn's a good way. Like, send a connection request, shoot me a message. That's where I'm most active, and I provide all kinds of freebies and advice and free products. As I mentioned, if those of you who are passive investors or even sponsors or fund of fund managers, if you want to know like what we look for when we're analyzing an opportunity, you can go to goldhawk.us/inspection and download our like 69 question checklist for what we look for in a deal. So that's a really good resource as well.
Very cool. Awesome. Elijah, I look forward to following you. Definitely appreciate your time, and we will talk soon.
Thanks so much, Josh. Appreciate it.
Thank you. Bye.